Hello and welcome to this week's instalment of Nucleus Investment Insights. We take a break from our recent flurry of high-quality guests and bring it back in-house this week as we turn our attention to the recent sharp sell-off in global equities, including a big pullback in the heady Nasdaq index. News has broken over the last week that Japan-based hedge fund Softbank has made significant bets, reportedly around $30 billion USD, on some well-known tech stocks in May, involving considerable amounts of leverage using call options. Whilst probably not the full cause for the pullback this week, it has certainly helped shine a light on what can lie beneath exuberant market rallies and the shaky foundations that sometimes underpin them. Joining us today to discuss the Nasdaq crash and gamma flips and explore how these themes play out in our portfolios, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Also on the line, we have our Chief Strategist, David Llewellyn-Smith. Welcome back, David.
G'day, Tim. Good to be back.
Fantastic. And just a quick reminder that before we get started, to subscribe on YouTube and click the notification bell to be notified of when we go live or have a new webinar to watch. And follow us on your preferred podcast platform. And for those listening in live now, feel free to drop in your questions in the chat box at nucleuswealth.com/webinar, and we can answer those along the way. So we'll kick off today with the agenda. So we're going to be looking firstly at some trading issues, rolling then into tech stock fundamentals, passing then to market valuation, and then finishing up, as we do, with an investment outlook and how we incorporate these themes or use these themes in the composition of our portfolios here at Nucleus Wealth and the MB Fund. So with no further ado, we'll hand over trading issues, a handful of stocks driving performance, fellas.
Well, this one's pretty straightforward. We've all been, sort of marvelling at the irrepressible rise of US stocks in particular. Global stocks have been far more subdued really after about sort of May and have largely tracked the S&P 495, which if you look at the chart we have here is pretty much sideways. Haven't gone much anywhere. But then there's the 5 sort of FANG stocks that have gone absolutely bananas ever since and have completely decoupled from everything else. So what we've had is what some people are calling a K-shaped recovery, where you have a handful of virus winners that are also backed by a number of unusual market dynamics, which we'll come back to, driving immense returns, bubble-sized returns in size and pace, while the rest of the market has been completely left behind. Excuse me. So, I mean, that... Yeah, go on, Damien.
Yeah, because it's worth noting as well that often when you see this type of setup, is often towards the top of a market. Now it's not always, because like sometimes you do have some big stocks that are genuinely better than the rest of the economy and charging ahead. But often when you see this sort of setup where it's only a very small number of stocks that's actually driving the market higher, that's often a sign that you're getting very close to the top.
Mm-hmm. Very good. All right, so we'll jump across to our next chart, the extreme option volume. Might be worth just working through these as well, fellas.
Yeah. So the issue, like we've spoken in the past about some of the things that could drive these market blow-offs when you sort of start reaching the top, and usually, often it's got to do with leverage. And in the past, if you look at various times in the past, you can see that that margin lending in particular picked up and sort of people taking out debt to buy shares, and that's sort of what really drove it to the extraordinary heights. This time that hasn't been the case, but what has been the case is a lot of options trading. And what we've got here on this chart is a bunch of different lines sort of showing people that are doing exchange traded fund calls or puts. So basically these are people who are saying, well, I'm worried about the market, for example. You can see a spike back at sort of early 2000 2020, where a bunch of people bought puts on the market to try and hedge the downside, to try and make sure if the markets fell that they would actually, it's like insurance. And then the calls is when people are is taking bets on the market going much higher. And so that's sort of one side of it. The next side is when you look at actual single stocks. So people that are doing the same thing on individual stocks, and we can see that this latest run up has really been driven by this huge disconnect between people having taking positive bets on stocks versus people trying to insure against or take out insurance in case the stocks go down. So you can see that the pink line on that graph is what, 3 times, maybe 4 times higher than its average level. Just dramatically higher in terms of the number of people taking bets on individual stock names.
Okay. Yeah, sure. Very good. And just on that, I guess, and for those that probably may not be aware of these stock calls and puts, I guess from a operational point of view, so these are made by market makers. Is that right, Damien?
Yeah.
So they're essentially generated or built and sold to the market, and typically the domain of perhaps institutionals for doing that hedging work you were talking about in the portfolios. It's now sort of bled across into retail. Do you think?
Yeah. Well, let's flip to the next chart, because I think the next chart sort of showing is quite telling in terms of that. So I've got so the answer is yes. It's usually the domain of larger traders, but that hasn't been the case recently. So if you look at small traders, so we talked about the total volume being 3 or 4 times higher than it usually is. Now we're looking just at small traders in a similar type of graph, not exactly the same, but you can see here now that we are, I don't know, 10 times, 20 times higher than the usual. Like it's just off the charts. So the number of small traders who are taking out call options is dramatically higher than what it's been in the past. And what that means is that this isn't buying call options, and especially short dated call options like the traders are doing. It's not the same as investing. You're basically putting a small amount down with a view that you could make easily make 5-10 times what you've put down, but just as easily lose a lot.
That's right.
And so it's a very high risk strategy, but it's obviously very popular as well. I don't know, Dave, if you've got anything you'd like to add, Dave, the rise of the day traders and.
Yeah, sorry about my delay. I mean, I see this kind of as a new generation bubble, I guess. I think every generation kind of has to learn its lesson, and we're into the millennials here, where I think there's some kind of identity thing going on here with a lot of people finding themselves at home, rather than in the office during COVID. Probably been juiced up on a bit of free money from the government, and you have a lot of these young guys that love tech and particular kind of tech stocks, and Apple and Tesla, etc. And these things kind of represent not just returns, but also identity of future of mankind, etc. And I think you can segue that into a narrative where you've got a bit of a millennial bubble going here, and they're also much more au fait and comfortable with things like cryptocurrency. They seem adept at pushing into new markets, and that they've waded into options and gone super leverage long on this stuff is perhaps an indication of an innocence of a new group of traders, and they'll learn their lesson.
Do you think it's a question of availability as well? Look,
yes.
I've been trying in and out of the markets even since my heady days have been in the mining booms when I was in the mines, and whilst you're playing around with penny dreadfuls and getting a few tips, you didn't really even think about options back then. They were sort of well outside of your wheelhouse. Where these days it seems with is it Robin Hood et al. They've sort of commoditized the options playing game and turned it into a giant casino, perhaps.
Yes, is the short answer. I think.
Yeah, the other part these though, like people love what you've said there though. Like I guess matches what a lot of people are looking at for small amounts of money. You know, the tech boom was famous for it as well. As people just like, where can I double or triple my money? You know, and that's the haven of small mining companies or small biotechs is exactly the same thing. It's about saying, I just want to put down, you know, a couple $100 or a couple $1,000, and I want to make, you know, 5, 10, 20 grand out of it.
Yep.
If everything goes great, but I'm probably more likely to lose a lot. And then says, oh well, I'll go again. You know, and I think that's it's obviously it's much harder to make those types of gains in the big cap stocks if you're not using either leverage or options. And so, you know, I think there's that, you know, as Dave says, there's people, you know, I think it probably kicked off initially as well as you've got a bunch of people who no longer had online sports gambling. Just disappeared pretty much overnight. And so for people that did like to sort of stray into those areas, you know, they might have never traded before and then got a chance to, and the timing was good in that, you know, they got a chance to trade as the markets were rising. And there's actually we'll talk a little bit more about it as we go ahead, but there's this whole self-fulfilling prophecy thing where if you can get enough people talking about a particular stock on chats and Twitter and a bunch of other boards and out buying that stock, then the stock goes up regardless of the fundamentals of it. And if you're all using options, then you're all, you know, even though you're only spending $1,000 each or $2,000 each, you're getting 5 times or 10 times the leverage, because there's still market makers behind it that need to hedge it, and they need to go out and buy, you know, significantly more stock. And so it's sort of this whole, we'll talk about that in a little bit more detail though.
Yeah, just one final thing as well. It's probably with the rise of, you know, these communication platforms, you know, like you've got your Reddit sort of et al. There's one that Wall Street Bets is one that gets trotted out quite regularly. It's even made it into mainstream news, which is, you know, basically a channel for people that actually, this is their day, you know, the daily thing. They put up their posts of their wins. You probably don't see a huge amount of losses. You do see a few. And then there's another one called ASX Bets, which is sort of the Aussie version of it as well. But, you know, people, as you say, people talking about it, sharing wins, you know, 10 people hear about it and they get in it.
Yeah, it's the Instagram of stocks. So you know, on Instagram, you everyone's showing off their latest engagement ring or their latest holiday or whatever they are, and this is the equivalent.
Same thing. Yeah, screen caps from Robinhood. All right, very good. We'll jump across to our next one, Softbank. So it's behind it all.
Yeah. So you know, this is a. You know, it's popped out in the last. I think probably Friday was when it first started doing the rounds. I think Dave, was it?
It's been dripping out via the blogosphere for a while, but it became formalised in the MSM around over the weekend. I think the FT picked it up. Yeah.
So there's been although there's lots of small people out there, as we saw from that one, there's certainly been larger ones as well, and the rumors have been doing the rounds that there's a whale out there who's taking some really big bets on it. Now, Softbank, for anyone who you know hasn't heard of them before, they're very famous for their venture capital business. So they sort of, I think they started as a telco or something like that in Japan, and they have a famous founder, and he basically turned $20 million investment in Alibaba into, I think, 60 billion or something like that. So just, you know, this massive performance and now they have the largest venture capital fund in the world, I believe. It's sort of $100 billion of venture capital, and they keep trying to do new raises and things like that. So there's sort of a bit of a halo to it, but there's also a bit of a they've certainly been in the press recently for some sort of for some shoddier work. They were a very big investor in Wirecard, and Wirecard ended up being a fraud and blew up bucket loads of money. Softbank did manage to get out without losing anything or without losing anything substantial, but like they got back with at least what they put in plus more, I believe. So they're sort of, you know, in a way they're it's sort of like, well done guys for not getting caught on that one, but they were knee deep in it. So sort of like a question about, did they just sort of, pump this up and then leave everyone else holding the bag. They've got a lot of flack for WeWork, and there's been a few other sort of investments they've had where the there's concerns over the way they're accounting for some of the profits. There's certainly valuation questions about whether they're just revaluing their own assets. They buy an asset for whatever $500 million, and then they say, oh no, it's not worth 500 million now it's worth $1 billion. And then they're like, well, why is it worth $1 billion? Well, because we just paid the equivalent of $1 billion for it. It's almost like they're marking their own homework.
Yeah.
So there's certainly, there's they've got a lot of haters out there, I suppose. Let's put it that way. There certainly seems to be a fair bit of smoke, and the questions about due diligence, which seem justified, but on the flip side, they are one of the biggest, or if not the biggest, venture capital funds in the world, and they've certainly had a number of good, investment outcomes. So there's that on one side. You've also they hired a bunch of ex-Deutsche Bank traders to sort of start this new venture, and the Deutsche Bank doesn't have the best name in terms of, they've had a lot of problems at Deutsche and a lot of compliance type problems at Deutsche Bank as well. So there's sort of that same waft, I suppose. That's or certainly aspersions, same aspersions are being cast. And so a lot of these trades, sort of have fallen under the remit of this ex-Deutsche team, and so the pitch from Softbank was basically that they'd started up this new fund, and it was going to be a lower risk thing than all this private equity stuff. And now it's come out basically going, well, is this a pump and dump scheme where they've been out, putting billions of dollars into these single stock names in call options, in order to sort of help push them up in order to be able to dump it and get out before everyone else. So there's certainly lots of smoke and issues behind Softbank. My best guess is that I don't think they're completely behind it. I think they've certainly been pushing it in the same direction, but there's plenty of other investors. I think George Soros is very famous for saying, I find a bubble and then I rush to invest in it, because bubbles, if you can find a bubble and then pump, it's generally being pushed up, and some of these momentum traders can jump in and push it up even more, and as long as they jump out before the whole thing falls apart, then they congratulate themselves. So I guess in my mind, I'm not sort of saying that Softbank's the evil villain behind the whole thing, and all these poor millennials are being, dragged along. I do think I do think they're playing a part in it, but I don't think you can sort of put the blame all at their feet.
Yep.
Dave, what you've been seeing on it, Dave? Nope, lost him again. I think there's that obviously that microphone.
Having a bit of fun with the microphone.
Sorry, I said that summed it up well.
Okay.
I'll just turn it off again.
Yeah.
There we go.
Okay. So coming back to this gamma flip. So this is the big thing that which is on the next slide. Now this is what sort of drove the Nasdaq down sort of 10% over the last few days. We did have a sort of a bounce back last night, but there's obviously some significant volatility happening there, and it's not a simple concept to try and work out the gamma flip, but I'll try and explain the basic version of it, which will hopefully give you I guess enough of an indication of how these things work. So I think the best way to think about market makers is like a racetrack bookie. So they're not out there trying to bet on horses. They're trying to take other people's bets and then offload them onto other bettors. And the same way market makers are trying to find people that want to go long in particular stocks, and then offset that with people who want to be short and in these options market, and take a margin on pricing these things up. And so they don't want to take any stock market risks. So what happens is when an investor buys a call option from them and they can't sort of offset it with other options elsewhere, then that market maker needs to go out and buy stocks or futures, and they do it on a day-by-day basis. So as the stock rises, they buy a little bit more and a little bit more, and then as the stock falls, they they don't have to worry about their exposure as much, and so they can sell away. So, for example, Tim, if you gave a market maker $1,000 and your option's worth $1,000, he'll go out there and buy enough stock so that if
it goes the other way.
If it ended, that he'd be able to give you $1,000.
Yep.
And then the stock goes up the next day, and then he'll go out and buy some more. And then the stock goes up again, he'll buy some more, so that now you're worth $5,000. And he goes, well, I've actually got that $5,000 ready to give Tim, on the back of the stocks. But the thing is that the ratio he needs to hold changes every day, and it actually creates this feedback loop where, and if you're doing it in very short dated options, which is what's been happening in the market, so much higher risk options because they're only running for a week or 2 weeks, you get this feedback loop where a bunch of people buy short dated options. All of a sudden, the market makers have to rush out and buy all this extra stock, which then drives the stock higher. Which then the market makers then have to go and buy more stock and you get this this drive upwards. But the thing is, once the volumes, if you're not adding more to this all the time, so if you're not just increasing, we saw that parabolic line of the increases in the number of options that were happening. If you don't keep adding more and more people buying these options, then eventually the options start expiring, and the market makers have to get to start selling the stocks that they've got, and it starts going the other way, and then they sell the stock, and then the stock goes down, and these calls are now worthless, and they can sell even more. And so it's that feedback loop in reverse, and that's where we went last week. Is that we'd really had a couple of weeks there where it just been really, really driven higher by those couple of stocks, and then finally that. And it was still rising. The number of options was still rising, but it just wasn't rising as fast as it had been in the past, which then meant, the feedback loop goes into reverse, and then all of a sudden you go the other way. So that's what a gamma flip is, and that's what happens. So the gamma is basically it's sort of like, it's almost a second derivative, you can think of it in terms of how it's working. It's a bit like the acceleration. Yeah, like the acceleration. So so it's I guess there's other, and keep in mind as well, there's other trading issues out there. There's a lot of momentum players. So these are people who just look for stocks that are going up and then buy them. With that view is going, well, generally speaking, if you can get onto a trend and then get out before everyone else, then you do well. And they're generally right. And it's sort of like it's almost as if, and that's a bit self-fulfilling as well, in that, if other investors are following those same trends or technical analysis and looking at lines and saying, yes, this is going higher, then they buy it, which makes it go higher, which then brings more investors. And so, yeah.
So
that same.
So just on that, I guess, and just zooming out a little bit, obviously we've spoken about the marked increase in either, retail and just overall use of, say, call options, and exactly what you're saying there, where it sort of turns into this self-fulfilling prophecy. That just lends to me that, in the future, if this sort of continues, then volatility is going to be exacerbated. It's, you're talking, the shifts that we see, or have seen rather, it may become the norm. Would that be correct assumption, do you think, if these sort of derivative usage sort of continues?
Yeah, absolutely. Anytime you get lots of leverage or lots of options, you absolutely increase the volatility in the market.
Yep.
And having a bunch of retail traders, all sort of first-time novices, all playing in the derivatives is very much a recipe for the same. Yeah. So definitely.
It's ironic because their sole reason for being is supposed to be to contain volatility. But
derivatives, you mean?
Yes.
Yeah, as in like for portfolio
futures
hedging.
And options in particular, they're about hedging and containing volatility in stocks as much as commodities.
Right.
But they both actually backfire.
Yep. Yeah, fantastic. Yeah. All right.
Well, as with anything, it's any weapon can be turned for good and for evil, and so you can certainly use these to, as you said, you can use them for good purposes, but people love to have leverage and they love to make bets on things, and so
and I guess in that vein, then, do you think Do you think then, like the sort of feels like near saturation level as we saw in that previous chart of options into the retail market? Do you reckon that this is sort of a legislative angle then that potentially they may after a period of high level volatility the powers that be sort of go, look, we can't have this in the stock market. It's it's eroding confidence, and we're going to have to do something about the driving forces.
I don't think our
not so long as it's going up. No.
Yeah, that's right. Yeah. Nobody minds about upwards risk. It's a downward risk they worry about. Look, if there was going to be more regulation, and there's arguments about whether there should be more. I'm sure there are reasons to have more regulation and make it a little bit harder for people, or at least lift the level of knowledge they need. But it's much more likely that'll come when everyone's picked up the pieces in a few years' time, rather than
on the way up.
Ideally, you would have regulators that would be stepping in and saying, maybe we shouldn't have people who've never traded before out buying the riskiest stuff they can find.
Yep.
But I think Trump would love a higher stock market, and so he's relatively regulation light, and so it's not going to affect the US. And I guess that's which is the epicenter of it all. So if it's not affecting the US, then other countries putting more regulations on, I don't think it's going to stop too much. So
fair enough.
So no is the answer. I don't think it's
no regulatory risk. There you go.
Coming.
Go long, Robin Hood. Jump into the next one.
So the next part I wanted to talk about was the tech stocks themselves. So the fundamental side, because in terms of every bubble, there's a grain of truth within it, and the tech stocks actually look pretty good from an earnings perspective. Like I've just thrown up on this left-hand side of the graph, Apple, Google, Amazon, Microsoft, just as samples, and just showing you the red line on these graphs is the 12-month forward earnings. So the next, so like a rolling period where you're always looking forward 12 months, and then there's very light lines that show the individual years. And you can see from that Amazon, a little bit bouncy, but it's basically been it's up much higher than what it was a few months ago. Certainly much higher than where you were at the start of the year. It's sort of up, maybe a third on in terms of its earnings. Microsoft, you couldn't, if you didn't tell you there was a pandemic going on in there, you wouldn't be able to tell it from the numbers. It's just sort of a 45. Not quite a 45-degree line, but certainly a bottom left to top right type of graph, just steady rise. These companies are coming through with the earnings, and the earnings are rising. Future, and I think there's a lot more faith in these numbers now. The flip side, Disney, you can see, so the old school ones I've put on the right, and you can see where Disney's really been smashed by this. And it's not just a lot of its media stuff, as well as its physical assets. Even an industrial like 3M, which is has got.
I thought they made masks. Hang on.
They do. Yeah. So I've actually thrown them in. Like I initially put in, I can't remember, General Electric or a few of these other sort of big name older school ones, which had sort of similar graphs to Disney in terms of earnings had just been smashed. But then I thought, well, actually, I don't want to just prove the point of by pulling out the worst of them. If you pick out a stock, an old school stock that's done all right out of this. And it's got divisions that are making masks and things like that. So they've got positives as well as negatives. But that graph's at best sideways, and it's still earnings are still considerably down on where they were at the start of the year. And so if you're looking for stocks to buy, then on a purely fundamental basis, ignoring the price completely, then there's certainly good reason to be looking at the tech stocks, because they are, their earnings are either unaffected or positively affected in a lot of cases.
And just a note here, these are the charts that are from our client dashboard. Is that right? These ring a bell. I've seen these before.
Yeah. You can get the
clients
dashboard for that's right. So we like to sort of just show all the stocks that are in our portfolio. We like to tell people why they're in there and show them the numbers, and so they can see our reasoning for investing in the stocks.
Very good.
Yeah, so that's the fundamentals of it. And then you sort of go, okay, well, what about the valuation side? Actually, sorry, Dave, did you have anything on the fundamental side?
No, that's good. Yep, carry on.
Yep. So the valuation side. So I've got two charts here. One is the earnings on the right hand side. And so for anyone sort of listening in, we saw I've just sort of benchmarked it to the start of 2018, and so you saw US earnings up about 20% to a little bit more than that to just before the crisis hit. From there, they fell down almost 30%, and then a bounce and sort of stay there for a little while. And this is the forward earnings as well, so it's sort of that bit about always constantly looking forward. So as time passes on, you start getting more of the future years and less of the prior years.
Mm-hmm.
But you've seen a decent bounce, sort of 10% bounce off the bottom, a bit more. You're still down about 20%, almost 20% from the original parts. And our take is that seems pretty reasonable. It's about I don't know if actually I'm certain the earnings profile won't be as we're seeing within stocks. There'll be some stocks that'll do worse, and some stocks will do much worse than what people are expecting, and some that do better than what they're expecting. But I think in light of what we can see at the moment, these don't seem completely unreasonable. Whereas a few months ago, the numbers we were seeing were just at the start of the crisis, we were saying these numbers haven't been adjusted yet, and they had further to fall. Whereas at this point in time, we're saying, okay, well, I do think there's enough sort of factored into it, and we've actually seen 2 reporting seasons effectively. So analysts do have a much better feel for it.
Just on that, Damien. So your thoughts, I guess, and on I guess there's this theme of, say, fallen angels, where you do get some shocks. Now, obviously, as you mentioned, we have we've had a couple of COVID era earnings announcements and whatnot. Propensity, I think, for fallen angels going forward on the COVID basis, I guess, as opposed to everything else, where they might get tipped out of bed on a rough patch.
Yeah, well, certainly. One of the things I really noticed over the last say week or so, just before we had this fall pullback, and actually, certainly even last month, actually, let's say the whole of most of August, was that a lot of the stocks that were rallying, a lot of the non-tech stocks that were rallying, were ones like sort of your Carnival Corps and things like that that are
coming off all-time lows.
Yeah, that's right. They've been smashed, and it's an expectation that I guess that people are going to start cruising again, or people are going to start holidaying, and so there's certainly stocks out there along those lines. I'd say even Disney's and things like that are formerly would have been thought as relatively high quality stocks, but in the current environment, you need to make that assessment. Do you think we're going back to normal in a short order, in which case those things are very cheap? Like if you thought we're going back to where they were in 2019, and you can pick up a lot of these travel stocks at current prices, then you're picking up bargains. If you, though, think the other way, that this is actually going to be a relatively long, drawn-out process, and travel is going to be slow and halting and isn't going to come back quickly, and people aren't going to want to travel even if they can, then today's prices are probably a little bit expensive. Yep. So it's a question of really where you see that coming back. We're erring on the side that this is going to last longer, and so we're sort of trying to find stocks that aren't going to do too badly if we get a rebound, but are going to do relatively well even if it is slow and halting. So having said that, try to find anything that's doing well.
Sounds like a tough
expensive.
Task.
Yeah, things that are doing well things that are doing well just got very expensive very quickly, and so now it's just a matter of for us, everything's all about that weighing up about what's the likely fundamentals versus how much you're paying for that. Because as you saw from some of those graphs, you get some really great fundamentals, but if you're paying 3 or 4 times the price you pay in something else, then you just got to question, even at those levels. I've often talk about the Cisco example, where Cisco was a good company, grew its earnings from but from the tech boom for the next 15, 20 years sort of fell pretty much, or maybe next 15 years fell, because the price was so high in the tech boom that even though the earnings were actually pretty good, you just couldn't justify it by the price. And so it always needs to come back to not just fundamentals but the price. And so the left hand graph, actually to sort of complete the circle, is is the forward earnings of the US market. So you can see it's sort of 24 times. It's basically double what it was in 2010 in terms of the valuations. It's way higher than it's been any time in the last 10 years. And you have to go back to the tech boom to get similar levels. What I've put though in as well is a red line there showing what would the PE be if you assumed that 2019 earnings were what we're going to get back to. So and that would come back in a relatively fast way. And so you can see there that even if you were extremely positive on the earnings and said earnings will be what they were in 2019 and they're going to bounce back really quickly, you're still at 10-year highs. You're still way above where you were even before the Trump tax cuts sort of started to kick in and sort of drove earnings higher from there. So even if you're really positive on the US market, it's still very, very expensive.
Yep.
Where you cut it.
All right, very good. And just a quick note before we jump to the next one, we've got the live chat open as well for anyone. Head over to nucleuswealth.com/webinar if you've got any questions you'd like answered along the way.
So now jumping to the Aussie market. So the Aussie market's got a completely different, well, not completely different, but a very different look at it. And sorry, actually, I've labelled that graph incorrectly. It's actually the S&P 100, the ASX 100 PE.
Okay.
Yeah. So you can see that earnings hasn't bounced back. So what's happened here is, whereas we saw the US over that 2-year period had risen about 20% and then fell back quite substantially, the Aussie market had only ever risen about 10% and has actually already started to fall even before coronavirus had hit.
Mm-hmm.
And so just before it, it was actually over the 2-year period, earnings had actually only risen 5%. They've then taken that same sort of 30% tumble that we saw in the US, but in this case though, there's been no bounce back so far.
Oh, and just on that, with as you mentioned before, so prior to COVID, we had this falling earnings, and I'll ask Damien first. I'll swing over to David, just give him a chance to turn his mic on. But thoughts on that. So obviously, we had we had pretty much, it was steady as she goes. There wasn't, no lockdowns, no reduced or zero immigration, and travel was gung ho. What were your thoughts on those decreasing earnings prior to 2020?
Yeah, look, I think the housing market had an impact.
Yep.
So banks weren't doing well. We've had years of almost no per capita wages growth, or certainly no real. So in inflation adjusted terms. So, despite the appearance of an economy that we were sort of pumping lots of people in, and so the GDP was sort of growing, the underlying levels, there were certainly a lot of problems. Australian households are some of the most indebted households in the world. I think we're number 2. So, and a lot of the growth over the prior decade has sort of been driven by this ramp up of people borrowing more and more and more money. And I think we're just reaching the limit of there's only so much money people can borrow before they just say, well, you know what, $1 million of debt's enough for me. I don't care if you're cutting interest rates even further. It's the actual level is reached a level where it's just too high to keep pushing that same thing further. But I'm sure Dave will have more to comment on that.
Yeah, that's more or less right. There's a bit of nuance we could add. I guess the peak of earnings more or less coincided with, you've got a sequence of macro-prudential policies that started to stall housing, and that's all about the debt story, obviously, that Damien's talking about. And then the Royal Commission was the real blow, and that, gave us a pretty healthy correction in house prices, and that started to spill over into consumption, and that's where you get that mid-2019 downdraft in earnings, and you had a government and a treasurer in particular with a plan to come out of it that was farcical, which made it a lot worse insofar as they decided to slash public investment in an effort to push the RBA to cut rates and get house prices and consumption booming again. And you had that, clearly as households wanted to deleverage, and rather than support that deleveraging with public expenditure, they went the other way with tax cuts and tried to reboot it, and it didn't work at all. And so in the second half of 2019 and coming into 2020, the Australian private sector was in recession before we even saw COVID, and you can see that impact on earnings. I mean, in addition to that, we were starting to see some headwinds on iron ore and bulk commodities and things as well, but they were the main dynamics. And then, obviously COVID hit what was a stall speed economy. We only had growth because public expenditure was growing, but not investment, only expenditure. And so we had a really clapped out economy when COVID arrived, and then we've obviously driven off a cliff, and we've now got a clapped out economy and COVID. So we've got no rebound in earnings.
And some of that earnings down. Australia has a lot of companies that earn money from overseas as well. So a lot of the miners and just a decent chunk of industrials as well. And so that's because the Aussie dollar has been rising. So that's been keeping those forward earnings down as well.
Right.
It has, although there's been big upgrades to miner earnings because the iron ore price has been so strong, which has been good fortune, really. China stimulus and Brazil accidents. And that gives you some measure of how bad domestic demand outlook is and for domestic earnings. So, I mean, there's been a point we've been making repeatedly on the blog. The prospect for earnings rebound in Australia is very poor because that iron ore price will come off next year and probably keep falling after first, second quarter next year as Brazil brings back the volumes. And China slows up a bit on the stimulus, and Australia will be driving austerity into domestic demand just as that happens. So the earnings outlook here is very troubled.
All right.
So what that means for the valuation side is interesting, though. So the graph on the left side is what I'm showing the actual PE, the blue line's again the actual PE, showing that's again at 10-year highs, and actually I think it's close to all-time highs in terms of forward earnings. The line on the right shows, okay, if the market's if you actually got to bounce back to prior earnings, the market would be about average value basically. So if you're extremely positive on the whole, if you don't believe us on the Australian side, and you think that it's all great, the doors will open soon, and immigrants will flood back in, and we'll be back to this economy where house prices keep going up, and everyone keeps growing lending at sort of 7 to 10% per annum, and we're back to the old days, then the Aussie market looks reasonable price at these levels. If you think though that as we do that we're not going back, immigrants aren't going to flood into a country that's got 10% unemployment.
Well, how are you going to let them in is my bigger issue. If there's no vaccine, that'd be a tough political football to kick around.
Yeah, that's right.
You're also assaulting the China student and tourist trade at the moment. So it's a full court press against immigration, even if it's not deliberate.
Yeah. Plus, interest rates have hit the level where, interest rates hit levels we pretty much can't go lower. We probably think we can now. Take another 25 basis points off. You think, Dave?
I like it. RBNZ's going to go negative, so they might drag the RBA there in 8 or 10 years.
That's right. They'll catch up.
But it's not going to matter much to mortgage rates.
No.
You'll get a little bit more, but no, they're at the bottom. So.
Yeah, but so so you've reached the bottom on that. As you said, in terms of the some of the commodity trade, I think there's of our biggest exports. Education's obviously having a hard time of it and not looking like bouncing back anytime soon. Coal's in certainly a long-term decline. Iron ore's had this short-term pop, but it's sort of reliant upon the virus being worse in Brazil than elsewhere, and because Brazil is our biggest competitor,
and it is improving now. And the other big one is just ham-fisted policy too. I mean, as we just described, we got this nice little recession, private sector recession before we had COVID, really based on what we've previously called the war of stupidity between the RBA and Treasurer Depressionberg, in which neither would either cut or spend, and they were in a game of chicken with these Australians just innocent victims in the middle. And
actually, I should expand on that for people who don't read everything you write, David. So what David's saying is, for the last few years, we've sort of had the RBA saying to the government, "You got to go out and spend more money. You got to go out and spend more money," but not cutting rates. Whereas the government was sort of sitting back, going, "No, we're going to balance the budget. We're going to be in surplus." And so, which is sort of basically flicking it back, going, "No, we're not spending money. Back to the RBA. It's your chance to cut rates even further." And so what that meant was we were stuck in this bit where, as Dave calls it, a war of stupidity, but very much a face-off between the two. And now we're sort of in this phase where both of them obviously relented, but there's still this sort of a little bit of stubbornness where, the RBA seemed to say, "No, I've done my job. We don't have anything more to do," a few months ago. And then they've just sort of come out and started doing a bit more now. The government's certainly doing a lot in terms of the spend, but question is, whether it's appropriately targeted and whether
and it's going to be wound back. So
and the wind back, yeah.
And I mean, the plan that comes in the wake of the wind back is the same one that they put in mid 2019 that gave us the private sector recession before COVID. And that is, they'll try to reboot immigration, but will very likely fail, we think, in terms of mass immigration at least. To force the RBA to do more. The RBA will be slow to do more, but the feds will also do their tax cuts again, which will again be saved as they were last year. When you have households, terrified under the doona and trying to deleverage, and so again, you're going to have insufficient public demand, especially on the investment side, where they've really let the nation down big time. They've let the infrastructure pipeline bleed dry in a terrible way. And so they're talking about rebooting it a little, but I see no commitment to anything really nation building, which is what we're going to need. And so we'll go back to that 2019 private sector recession. That'll be our recovery. Certainly as the economy opens up, we'll get our pent up demand and we'll get our pop, as Victoria reopens, etc. But that's a 6-month story. It's not an earnings driver beyond, the short term. And when you get beyond that, you really see nothing but earnings difficulties because fiscal and monetary policies are so poor, and the virus has really rocked what growth drivers we had, and then the terms of trade come off. So very tough.
A couple of questions popped in just while we're finishing off that last piece there, fellas. Quick one on your charts there, just to define what smaller investors are, Damien, in your charts. If you just quickly.
Yeah, I'm not 100% sure actually. I'd have to check. But look, my guess would be it would be people sort of with under 50,000 in each option one. I'm not. Yeah,
an exposure.
I'm not sure.
Yeah,
exposure on an individual trade, but I must admit I'm not sure.
Okay.
That's sourced from where is it? OCC. So yeah.
Okay.
To follow up on that one.
No, that's all right. Another one on currency here. Do you think the falling USD will cause major selling pressure in the US market as foreigners sell to bring their money home? And would this explain some of the reason for the rising Aussie dollar? Do you need to be bringing home some serious bacon, I think, to cause it?
No, the falling US dollar is a positive for US equities because it helps boost what are very significant foreign earnings in the S&P 500.
Mm-hmm.
And obviously increases competitiveness for the US economy generally and helps boost exports, etc. but certainly that's an upward pressure on the Australian dollar. I think they don't have to go hand in hand, and I think my basic thesis now is the US dollar will continue to fall. Like, I think the virus crisis is kind of slowly grinding to its conclusion as we're, figuring out various ways of keeping it suppressed, and we're going to get some vaccine waves and et cetera, et cetera. And we're now entering the sort of economic/markets reckoning where we're going to wind back the stimulus. I think once we get past the US election, that's obviously a risk to everything and could create volatility in all the currencies. But once we get through that, I think the trajectory for the US dollar is still down, as it tends to be in global recoveries, especially if Biden gets in, but I think it'll probably happen either way. And that'll be upward pressure for the Australian dollar. But what we've just been talking about here with the really bad outlook for the domestic economy and earnings in Australia is going to weigh very heavily on that. And if you add, falling iron ore prices, which I think are inevitable next year, to, probably back to an average of $60 by the second half, then, you could very well see a falling US dollar and a falling Australian dollar next year. Like, I don't think the Australian dollar can get all that much higher from where it is, because I just think the economic outlook will be so poor, kind of beyond 6 months. And then, you could actually have quite an unusual scenario where you have both falling, which I'll just put in would be very good for gold and local gold miners.
Right. Okay. Very good. All right. Well, maybe we'll just tidy up.
Sorry, that's the last point I wanted to make on those ones, as was what David sort of just touched on there, is this idea though that we've put on pause all these insolvencies, and people are getting kicked out of homes for not paying their rent, and we've put ourselves into the eye of the storm, as we're calling it. So in terms of saying, look, it feels really good when you're there, because you're like, hey, companies aren't going broke and people aren't getting kicked out of their homes and all that sort of stuff. But there's all these people accruing these extra debts, and there's these companies that aren't going broke, that should have gone broke, that are out right now racking up more debts to more people. And some of them just have no hope of surviving and would be far better off in administration and working either where they can people can have a look at them and either say, no, this thing isn't going to make it, let's cut our losses now, or no, we can actually trade out of this, let's put a plan in place to trade out of it. But that's not happening at the moment. It's basically still back with the directors just saying, a lot of them who are just crossing their fingers and saying, well, I hope demand bounces back, and in the meantime I'll just keep racking up debts to everyone. And so what that means is that creditors of these companies who might have otherwise got something now get nothing, because the employees will get it all, or maybe the employees don't even get to pay their money, and they're back to taking money from the government to fill in for those. So it's going to be a big issue when it comes. It'll happen probably I think the US is the most likely place to happen sooner rather than later. The US tends to be more ruthless with these things. A lot of Europe's sort of doing similar delays to what we're seeing in Australia, where they're just sort of saying, well, let's just delay it again and hopefully things will be better. Whereas I think these types of delays to me are best suited for very short term, 3-6 month sort of time periods, after which you've just got to let there's too much risk for moral hazard, and there's too much risk that the bad guys start pulling the good guys down with it. And you just you don't get spending, because I think as we had well, I guess recently Stephen Mitchell said, whenever these things happen, it's the tradies that are always the ones who get hit the hardest, in that they're the ones who just won't get paid for projects in the development space. And it's sort of similar in some of the in other businesses. It's the small guys that'll be the ones that really cop it, and that's where that flow on effect to the rest of the economy is yet to come.
And as much as they're obviously not listed and investable, there's going to be an impact on the top end as well, as demand falls across the board, as you've been covering off.
Yes.
Yep. Yes. Roll through into the investment outlook, mindful of time.
Yep.
Caution warranted. Surprise, surprise.
Yeah, that's right. Look, it's so I mean we're sort of still we've sort of been moving things around a little bit. So bond yields, some of the longer term bonds we tipped back out of and got back into some of the shorter term bonds. We think within international, certainly a much safer place to be playing than in some of the Australian markets. You have to be pretty careful about valuations, but yeah, certainly there's more value there we can see. We are in this really low return environment, so it's sort of this. We've got the it's a paradox in a way, but not only are we facing this bit where interest rates are so low that and prices of property and prices of growth assets like shares are so high that you can only sort of see this very short term. Sorry, you can't see a lot of earnings coming out of this. But the flip side is there actually looks to be more volatility around these than what we've seen in recent times as well. So, from a tactical point of view, our view is that over the next few years, just buying and holding is not going to give you a very attractive return, and that you're going to need to be a bit more active than what we have in the past.
Okay, very good. Yeah, thanks for that. Any final notes there, David?
No, mate, that's good. Thanks for having me.
Oh, thanks for coming back. Yeah, and thanks to you, Damien, for a great show. And certainly, I think plenty to think about going forward. And also, I'm sure we'll hear. It won't be the last we hear about what's been happening in that option market and those sizable shifts. Coming up next week, we have our special guest in John Denez, who is Chief Investment Officer of boutique fund manager Paragon. He'll be back on the show. He's come on early this year. He'll be joining us next week to share his views on the world's favourite currency hedge, gold, which after a terrific run in the last couple of years appears to be taking a breather, albeit at all-time highs. And is there still hope for the yellow stuff yet? Tune in next week, Thursday, 12:30pm on the 17th of September for a live chat with John. And of course, head over to nucleuswealth.com/webinar to ask questions along the way. Thanks again to all those who've watched and listened in live for another great episode. And thanks for those who asked questions as well. I hope you've taken away some great ideas. We hope you've enjoyed today's show. And if you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date on news from us, follow us on our social media channels. We always appreciate guest or topic suggestions. So if you've got one, drop them in the comments of today's YouTube video or obviously on our site as well, and we can follow those up. And finally, if you know anyone who gets something out of today's episode, let them know about it, share with a friend, and help our show grow. So on that note, I hope you've enjoyed today, and we'll look forward to catching you at the next one. Cheers.